Hi there, accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover several questions from Chapter 12, investments, but we are particularly focusing on debt investments. But on a whole, corporations, they invest for three common reasons. They have excess cash. So if we think of a company like a marina company, one that rents and leases boats. Typically, in the spring and in the summer seasons, that's where the bulk of their cash flow comes in as opposed to fall and the winter. So, in those seasons where they have idle cash, rather than just keeping it in the bank, they decide, hey, you know what? I'm going to let my money work for me, right? So, that could be one of the reasons why companies decide to invest either in debt investments or equity investments. Some corporations, they view investment income as significant revenue source. Again, that mindset of making their money work for them. And then sometimes they have strategic goals such as gaining control of a competitor or supplier that's moving into a new line of business. So that's more so on the equity investment side. So in this case, we're focusing on debt investments. In the next video, we're going to hone in on equity investments. And as it relates to entries for investments in debt security, it is very important for us to determine, are these bonds held to maturity? Are they trading securities, or are they available for sale securities? And the reason why this classification is important is because that ultimately determines how the bonds are going to be treated for reporting purposes. Because as we know, the value of debt and stock investments, they'll fluctuate greatly during the time that they're held. So with that being said, it ultimately depends on whether or not we are going to keep it, or the classification rather. If we're going to stick it out for the long haul and it is held to maturity, it doesn't really matter if the fair value increases or not, right? Because in such case, the fair value is not relevant, because one minute it might be worth, let's just say $100, and another day it might be worth 90. A few weeks from now, a few months from now, it might be worth 200, right? So there's going to be fluctuations. So that is why the classification, those three classifications, are very important. So here we see we have these questions. All of them are essentially using the same context. So we have Fuzzy Technologies Incorporated. They purchased a long-term investment, $80 million of 8% bonds dated January 1st. On January 1st, 2027, management has the positive intent and ability to hold the bonds until maturity. For bonds of similar risk and maturity, the market yield was 10%. The price paid for the bonds was $66 million. Interest is received semi-annually on June 30th and December 31st due to changing market conditions. The fair value of the bonds at December 31st, 2027 was $70 million. As we see here, it's asking us to prepare the journal entries. It's asking how much is it going to be reported on the balance sheet, and it's asking how is the statement of cash flows going to be affected by this investment. So here we see this is the first question. The key thing is that it says management has the positive intent and ability to hold the bonds until maturity. So we know that these are held to maturity bonds. So now if we look to the next, we're going to look to the next one, to question 2. And all of these questions, essentially, the key difference is the intent, the classification, essentially. So for the first example, it's held to maturity. For the second example, it is a trading security. And for the last example, it is available for sale. So we're going to work through the problem. So for requirement 1 is asking us to prepare the relevant journal entries on the respective dates. So the date that they made the investment on bonds. So here we know that the bonds are worth 80 million, but they only paid 66 million. So let's think of it like this. Let's make it even more simple. There's a pair of shoes that are worth $80, but you only paid $66 for them. In our everyday life, we would say that we caught that, or we purchased the boots, the shoes at a discount. The same thing is happening in this case. And the reason why there's a discount is because the corporation that Fuzzy Technologies purchased the bonds from, they are promising to pay 8% interest on the $80 million that they borrowed. However, if the corporation decided to purchase bonds or of similar risk and maturity, the market is going to pay 10%. So in such case, that's just like, the same example with the shoes. Let's say the shoes are $66 at one store, and at another store it's $60, right? So we're looking at it from the reverse angle. So now let's look at it from the perspective of money, right? You would prefer that someone gives you $66 versus $60. So with that being said, the market would give them 10%. This corporation is only giving them 8%. So with that being said, what the bond issuer does is to appease the bond holder, to give them an incentive, they issue the bonds at what's called a discount. So with that being said, we record our investment in bonds for the 80 million. And a very key thing to keep in mind is that if no entry is required, then there's going to be no journal entry. But for our answers, we're going to enter them with 2 decimal places. So 55 million, sorry, 500,000 would be 5.50. So in that case, our 80 million is going to be 80.00. So that's the value of the investment in bonds. So we use what we know to figure out what we don't know. So we also know that we paid 66 million. So based on the principles, the logic of accounting, we know that we're going to credit our cash for the decrease for 66 million. But we know that based on bookkeeping, fundamental principles of accounting, total debits and credits must tie. So therefore, there's a difference. There's a difference of 14 million. And we see again, the bonds are worth 80, but we only paid 66,000. So therefore, we are going to offset the value in our investment and bonds account with our contra asset account, discount on bonds investment. So this will be our first journal entry. The debit to the investment in bonds, our asset account for the full amount. We credit cash for 66 million because that's how much we paid. And then the difference represents the discount on the bond investment, which is going to be amortized over the period. So we record this entry. And then now for June 30th, it's asking us to record the journal entry. So again, they borrowed 80 million and they're promising that they're going to pay us 8% interest every year. So as we know, interest is stated on an annual basis. So 80 million multiplied by 8%. They promised that they are going to pay us $6,400,000 for borrowing our $80 million. So that's how much they promised to pay us in interest every year. But again, interest is received semi-annually. They're paying us twice a year. So they're basically breaking out the payments in installments, right? Just for an easy way for you to understand it. So if we divide it by 2, that means that every 6 months, we're getting $3.2 million. So it doesn't matter what's going on in the market. They are promising that every 6 months, they're going to pay us $3.2 million. So now the next step is ultimately for us to figure out, well, what is our interest revenue? And as it relates to our interest revenue, that is based on what the current market rate is. So with that being said, we know that the current fair value, the cost of the bond is 66 million. And then we know that in the market, they would have paid us 10%. But again, 10% is on an annual basis. So what we do is we can do two of two things. The carrying value, which is the 66 million, multiplied by the 10%, that would be what we would have received in the market for the entire year. But again, we are recording this journal entry every 6 months. So we divide it by 2. So therefore, our interest revenue is 3.3 million. And then you might say, wait, hold on, there's a difference. So 3.3 million. And the difference between the cash that they are promising to pay us and the interest revenue. So that is essentially how the corporation makes up for it. So they look at it as, hey, all right, we didn't give you the extra 2% of interest that you would have received in the market. So in order to appease and incentivize the bondholders, what they do is they basically eat the cost. They absorb the cost, for a lack of a better word, because again, when the bonds mature, they're paying them 80 million, but they only got 66 million. So with that being said, when we record the interest revenue, we amortize, we decrease the balance in the discount on bond investment account. And as we see, that difference is going to be the $100,000. The difference between the 3.2 million and the 3.3 million. All right, so this is our journal entry to record the interest revenue on June 30th, 2027. And then now it's asking us to record the interest revenue on December 31st, 2027. All right, so same logic, right? Doesn't matter what's happening. We promised, or they promised rather, that they are going to pay us $64 million every year, and they're going to pay us in 2 installments. So therefore, every 6 months, we are going to receive cash of 3.2 million, right? And as we just mentioned in a previous journal entry, our interest revenue is always going to be based on our carrying value. So the first journal entry was June 30th. There was no reduction to the discount on bond investment. But now, as of December 31st, we already had an adjustment to the value of our bond. So in such case, here we have the 66 million, which was the original amount of the bond, plus the $10 or $100,000 that we recorded for the discount on bond investment. So one thing to keep in mind, I actually have a journal entry that I want to show you guys. So this is essentially how it works. We're going to put together a T account. Let me see if I have the T account here. And if not, we will create one. All right, so what we'll do, we will put together an account, basically a T account, right? To kind of show you the increases and the decreases. Because again, one of the key things to keep in mind is that this investment in bonds account, that it is essentially, so 80 million. And then we have our discount, which is a contra account. So we have the discount on investment in bonds. I'm just going to create this quick T account. And this is just, again, an easy way so that way you can see exactly what's happening and get a better idea of how we came up with the amount versus just, talking through it. So here we have, again, when we first purchased the bonds, we have the 80.00. Let me actually, so that way it can mimic what we see. Perfect. So we have the $80,000, and then we have the discount on investment in bonds, which was the 14.00. So now, as of, and I'm going to try to make it clear cut. So as of June 30th, our balance for the bond is as follows. The 80 million, which is reflected in the investment in bonds, minus the discount on investment in bonds. So, see, it should be subtract. Oh, I did plus, my apologies. So it should be minus. There we go. So as of June 30th, the balance was 66 million. So that is essentially why for that journal entry, when we wanted to determine the interest revenue, we multiplied it by 66 million because that was the carrying value. As of June 30th, we also recorded the journal entry for the 100 million. So now our new balance in the discount on investment in bonds is as follows. It's no longer 14. It is now 13.90. So as of December 30th, the balance is the 80 million minus the value in the discount on investment in bonds. So that is how we get the new carrying value of 66.10. So just to kind of give you some logic, again, think of it like depreciation. When we have an asset, the asset is recorded as cost, right? Let's say you paid $50,000 for the asset, and then you claimed $2,000 worth of depreciation, the net book value is the actual cost, which is the 50,000 minus the accumulated depreciation of 2,000. So the net book value is 48,000. So kind of think of it from that same logic. So when we look at this entry, our interest revenue is going to be based on the new carrying value, which we just calculated, of 66.1. We multiply it. Again, you can multiply it by 10%, then divide it by 2, or you could just multiply it by half of that, which is 0.05, either or. We divide that by 2. So therefore, our interest revenue is 3.31. It wants us to round it essentially 2 decimal places. So therefore, because the number after the 0 is 5 or higher, it is going to be 3.31. We round it up. And then now we see the difference between the two. We are now further amortizing the discount on bond investment, and the difference is 0.11. So then now if we open back up that Excel spreadsheet, now we see 0.11. So now the new carrying value for the bond is as follows: the 1390 minus the 11. So therefore, as of January 1st of the next year, the carrying value is as follows. So it is the original cost or the value of 80 million minus the new value of discount and investment in bonds. So the new carrying value is now 66.21. So as we see, with each passage of 6 months, the value increases. So ultimately, the goal is that when the bonds mature, the value in the discount investment in bonds will be 0. So ultimately, the investment in bonds value would equate to what is reflected, or what the carrying value is ultimately. All right, so that brings us to the end of the first 3 entries. Again, the first thing we recorded was the date of purchase. The next thing we recorded was the first interest revenue payment. And then the next thing we recorded was the interest revenue payment on December 31st. And again, in order to determine the interest revenue, it is based on the carrying value. And to give you guys a visualization of that, I created these T accounts to basically show you how with every journal entry that is recorded, the carrying value ultimately changes. So that brings us to the end of those 3 entries. So we score those. So now we move on to requirement 4. Oh, okay, it scored the whole thing. Okay, all right. So what we will do, we'll go through that. So at what amount is Fuzzy going to report its investment in the December 31st, 2027 balance sheet? So again, the key thing here is it says management has the positive intent and ability to hold the bonds until maturity. So in such case, it doesn't matter, right? Think of it like a marriage where they say for better or for worse, for richer or for poor, kind of sort of the same thing. It does not matter if the bond value goes up or if it goes down. They're in it for the long haul. So therefore, they are going to report the investment at $80 million, the original amount, right? So with that being said, again, the increases or decreases in the fair value does not matter because they are planning to hold it until maturity. So with that being said, right? All right, so let me scale back actually. So in such case, what they're going to do, they're going to report it based on the amortized costs. So with that being said, it's going to be reported at 66.21. So the 80 is essentially what's reported in the investment in bonds account. So I want to, clear up what I mentioned. So the 80 million is reported in the investment in bonds, but then when we net these two accounts, ultimately the overall balance is this 66.21. So how did we get that? Again, it's the value of the investment in bonds less the amount that is in the discount on investment in bonds account. So therefore, it is reported on the balance sheet as 66.21. So that would be the answer that goes here, 66.21. And then for requirement 5, It's asking us, how would Fuzzy's 2027 statement of cash flows be affected by this investment? Saying if more than one approach is possible, indicate that one is most likely. So, as it relates to operating activities, the cash flow from interest received is considered an inflow from operating activities. So, with that being said, if we go back into the problem to our requirements, we see that we received 3.2 cash June 30th, 2027, and we also received 3.2 December 31st, 2027. So if we add the two together, that'll give us 6.4 million. And again, that ties in to the 80 million bonds that we purchased. We lent the money and they promised to pay us 8%. We received an inflow of $6.4 million. So operating cash flow would be 6.4 inflow. And then as it relates to the investing cash flow, if Fuzzy prepared the indirect statement of cash flows, then they would have interest revenue of 3.3.0. But again, in such case, they are ultimately using the investment method. All right. So that brings us to this last point, where it's asking us about the investing cash flow. So with that being said, we would ultimately report it as the 66 million that was paid out. So we paid out the 66 million. So our investing cash flow would be 6.6 million. Sorry about that. I didn't realize that when I submitted it, it would answer or score rather all of the questions. So that's my fault. So again, requirement 4 would be 66.21 million. And I used the T account. Started off with the original balance. We started off with the value of the discount in investment in bonds. And then with the two journal entries that we recorded, it further reduced the balance. So therefore, as of January 1st of the next year, the balance is 66.21. And then for requirement 5, our operating cash flow would basically be the cash that we received in interest, and our investing cash flow would be the amount that we paid to purchase the bonds. All right, so I'll make sure I won't make that same error with the next problem. So again, same information. Bonds are worth 80 million. They promised to pay us 8%. The market is paying 10%. The price paid for the bond was 66 million. But now here's the thing. It says that management intends to include the investment in a short-term active trading portfolio. So, with that being said, because these bonds are considered trading securities, they are going to be treated a little differently. So, with our trading securities, this is essentially whereby we have these bonds available and they're readily marketable, right? We are prepared to sell it. So, with such case, these trading securities, we are going to account for the changes in value, right? So, with that being said, with our trading securities, we are holding them, but we have the intent to sell them in the short term, right? So, typically that's less than 3 months, and sometimes it's less than a full day because trading in and of itself frequents buying and selling. So, what companies do, they adjust these trading securities to the fair value at the end of each period. And this is an approach, it's often referred to as mark to market accounting. And then whatever changes, because we see here in at this last sentence, it says, due to change in market conditions, the fair value of the bonds was $70 million. So because they are trading securities, we are going to account for that cost. We're going to report the changes from the cost as a part of net income. And then these changes, they're going to be reported as unrealized gains or losses because the securities have not yet been sold. But the key thing is when we are dealing with these trading securities is that they are going to be reported on the balance sheet at fair market value. So with that being said, one of the great things about these problems that they're all the same. So with that being said, journal entry for purchasing the investment, recording the initial interest revenue, as well as recording the interest revenue for December 31st, they're all going to be the same, right? So none of those journal entries are going to be different. They're all the same. Now, where things are a little different is in, and I'll just, reiterate those entries so everyone can see. The key thing that is different with held to maturity and trading securities and available for sale is if there's a fair market value change. As we mentioned, held to maturity debt investments, those are recorded at amortized costs. Trading securities and available for sale securities, those are reported at the fair market value, but the initial journal entries are the same. So we have our investment in bonds for the 80 million. We paid cash of the 66 million. We credit our discount on bond investment for the 14 million. And then we have our journal entry for interest revenue. We know that they are always going to pay us 3,3,200,000. We multiply the rate from the market by our carrying value, which is initially 66 million. So therefore, we're going to get our interest revenue is 3.3 million. And for the difference, we reduce the value in our discount on bonds, 0.10. And then this is our last entry. Again, doesn't matter. They're still paying us this 3.2. But now, because our value, our carrying value increased, instead of it being 3.30, it now increased to 3.31. So again, these entries are the same. And then we're going to see this as well when we move on to discount bond 0.11. All right, so these entries are the same. All right, so I'm not going to make the same error. I'm not going to submit it as yet. So here it's asking at what amount is Fuzzy going to report its investment on December 31st, 2027? Again, because it is a trading security, in such case, we reported at fair value of $70 million. So there would be a journal entry that would be created, and that journal entry would ultimately help us to report and increase or decrease the value of the debt investments. So now we move on. So now it's asking us to prepare any entry necessary to achieve this reporting objective. So now the key thing is we need to figure out, all right, well, how do we essentially get the balance to tie? So with that being said, we see here that it's telling us that the value is 70 million as of December 31st, 2027. So we already did the work, right? So with that being said, we see here, this was the original value, or that is the value of the bond. But again, we had a discount. So when we first purchased it, the value was 66 million, the 80 million minus the value and the discount on bonds. That's after our first interest entry. And then after, or yes, our first interest revenue entry. And then now after the interest revenue for the first journal entry as of June 30th, we see that we recorded a deduction to the discount on bond investments for 10 or 100,000. So now we see it's the 80 million minus the 13.9. So therefore, the new value as of June 30th was the 66.1. And what I think I would do is actually, to make this a little clearer, I feel like this might be a little confusing. So as of January 1st, when we first purchased it, that would be the value. This would be as of June 1st, or June 30th rather. And then this would be as of December 31st. I think that should hopefully clear up some confusion. All right, so this is essentially when we first purchased the bond, the investment value minus the discount. And then as of June 30th, when we recorded our first interest revenue, it's the investment in bond minus the difference between the original amount and the discount on investment in bond minus the reduction or the amortized cost. And then as of December 31st, we see that the value is 66.21. So based on a problem, we see that the fair market value, this is as of December 31st, and then we know that the fair market value is 70.00. So based on that, the adjustment that is going to be necessary for the unrealized gain is going to be the difference between the two. So we see that the value is 70 million. And right now on the books is currently 66.21. So therefore, our adjustment is going to be for 3.79. So with that being said, our journal entry will be as follows. So we know that the debit is going to be for 3.79. And then the credit is also going to be for 3.79. And then we have these special accounts that basically helps us to track these amounts ultimately. So the first account that we essentially use is a fair value adjustment. So we have a valuation account that basically helps us to recognize any adjustments, whether it is a gain or a loss. And in this case, it was a gain. The carrying value was 66.21 and it increased to 70. So we increased the value. And then when we are dealing with trading securities, they are reported any increases to the value or decreases to the value, they're reported on the net income. So therefore, our credit is going to be to gain on investments, and it is going to be reported in the unrealized net income section. So with that being said, right, one key thing to keep in mind is that when we move on and we look at the available for sale securities, the only difference between accounting for the unrealized gain is that if we were dealing with available for sale securities, we would credit the gain on investments unrealized, which is reported in the other comprehensive income. So when we're dealing with trading securities, the unrealized gains and losses, they're reported in net income. And that when we are dealing with available for sale securities, the gains and losses are reported in other comprehensive income. All right. So just keep that in mind. This brings us to the next section. So in this section, it is essentially asking us how would Fuzzy's 2027 statement of cash flows be affected by this investment? So in such case, again, we know that we are dealing with the trading securities. So in such case, here we see that the difference would be the 59.6 million. So you might ask yourself, well, hey, how did we get that amount? So in such case, for the operating cash flow, and the key thing as we are dealing with the trading securities, this is a part of their business, right? So as we know, with the statement of cash flow operation or operating activities rather, these are things that are part of the normal course of operations for the business. So these trading securities, again, trading means that there is a intent, there's frequent buying, frequent selling. So it's part of their operating activities. So we know if we go back, they earned 6,400,000. So 3.2 on June 30th and 3.2 December 31st. So we add those two together. So we have 3.2 plus 3.2. Oh, sorry about that. 3.2 plus 3.2, which is 6.4 million, right? So that's a positive. But then we also know we paid out 66 million. So when we net the two, we get an outflow of 59.6, and this is considered an outflow and there's no investing cash flow. All right, so again, the key thing when we are dealing with the trading securities is that it is a part of their normal course of operations to sell and to buy bonds. So therefore, the operating cash flow is impacted by the interest received as well as the amount of money paid to obtain the bonds. So that brings us to the end of this question where we're looking at the active trading portfolio. See, it's saying something is off. Oh, I think I forgot to put zeros. Okay, so that was my fault. Forgot to put zeros. So you want to make sure that you enter that in the program for this problem so that way you don't miss any points. You would input no effect. So here where is this showing this X, you would input no effect. So that was my fault. All right, so this brings us to the last question. All right, so with that being said, I'm not going to waste time going through the journal entries. They are the same when you record the entry, when you record the interest revenue for June 30th, and when you do the same thing for December 31st. Now it's asking us at what amount are they going to report the investment December 31st? So in this case, we are now dealing with the third classification where it says management intends to have the investment available for sale when circumstances warrant. So debt investments that are considered and classified as available for sale, they are treated similarly to trading securities. So with that being said, they're also going to be reported at $70 million. So now it's asking us prepare any entry necessary to achieve the reporting objective. So as mentioned, the value of the bond is now 70 million. Because we recorded the two journal entries as of December 31st, the balance was 66.21. The fair market value was 70 million. So therefore, we need to make an adjustment to the unrealized gain for the 3.79. So as mentioned previously, the only difference between this journal entry for available for sale securities and for this example, where we are, or the previous example where we did trading securities, and this example where we do available for sale, is that it is not going to be treated as unrealized net income on the income statement. It will be gain on investments, unrealized other comprehensive income, which is a part of stockholders' equity on the balance sheet. So that is the key difference between trading securities. The unrealized gains and losses are reflected in net income on the income statement, and for available for sale securities, they are reported in other comprehensive income on the balance sheet. So that would be our journal entry. And then lastly, it's bringing us to asking us about the cash flow and ultimately, what the impact is. So again, available for sale, this isn't really a part of our, normal course of operation. So what available for sale is kind of like in limbo, right? We don't know if we're going to hold it to maturity. And we also don't know if we're going to sell it in the near term. So with that being said, our operating cash flow is going to be the two interest payments that we receive, which is 6.4 million. This is an inflow. And then the investing cash flow is the 66 million that we paid out, and this is an outflow. And then one key thing to keep in mind is that there is a difference between requirements 1 to 3. It asks you to enter your answer in millions rounded to decimal places. And then for requirement 5, it asks you to enter your answer in millions rounded to 1 decimal place. So you just want to keep that in mind. But that brings us to the end of questions for debt investments. So again, some key things to keep in mind is that companies, they invest in debt investments whereby they are lending money to corporations, lending money to the government with the anticipation of receiving the principal payment and interest during the life of the debt, the bond. And then they also have equity investments, which we will cover in the next video. As it relates to debt investments, there's 3 classifications. They are held to maturity, they will be classified as trading securities, or available for sale securities. And it ultimately all depends on management's intent. So with the held to maturity, again, think of it like a marriage, come better, for better or for worse, it doesn't matter. They're in it for the long haul. So the fluctuations in the price of the bond, it does not make a difference, right? Unless, of course, they decide to sell it before it matures. But with the held to maturity, those bonds are going to be reported at their amortized cost in comparison to our trading securities, which are reported at fair value, and they are recognized in our unrealized net income account. And then for our available for sale securities, those are also reported at fair value. However, they're reported in the unrealized other comprehensive income account. So that brings us to the end of chapter 12 and our discussion and review of homework questions for debt investments.